G'day, my name is Alphinity Jonker and I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Jeff Thomson with me. He's one of our global portfolio managers and also the analyst in the financial sector. Today we will be discussing the outlook on the global banking sector, specifically focusing on what's been happening in the US of late. So Jeff, it's been just over 2 months since the SVB collapse and a lot has happened for global banks. They've massively underperformed the MSCI World Index, and there's obviously a lot of unanswered questions out there. Can you, as a starting point, just reflect on what we've seen in the recent reporting season and sort of some of the key risks in the outlook from here?
Yeah, thanks, Elfreda. The earnings season probably was better than most people expected, and I think, I sort of caution, I guess in terms of extrapolating that, SVB happened right towards the end of the quarter, so a lot of these events weren't fully captured in the quarter, but probably the key, one of the key takeaways was the big, large so-called GSIBs winning pretty much at the expense of everyone else. So JP Morgan, and to a less extent banks like Wells Fargo and Bank of America, getting deposit inflows and faring quite well, and a lot of the other banks really struggling. The other sort of two thematics I'd call out probably would be a lot of speculation about the outlook for interest rates and whether we are at peak net interest margins. And then the other one is, continued normalization of credit. I think we've come through a very benign period of credit, but obviously with high interest rates, there's a reasonable expectation that is going to change quite soon. So far, you're not really seeing that in a dramatic way, but certainly some risk still on the outlook there.
So yeah, very early days, and probably will take some time to filter through. What are some of the sort of broader risks that you see longer term for the banking sector?
Yeah, Alfreda, probably, in terms of what's happened just most recently, I think the biggest risk coming out of this really, I guess, would be what are the regulatory consequences for the banks. I think that story is probably going to play out over probably years. You've already seen some impact already with the FDIC putting on surcharges to recoup some of their losses, which is going to translate into earnings downgrades. You're obviously going to see an expansion, I think, of regulation into sort of those regional banks, which was a little bit of an oversight from the regulators. But I think to the extent higher capital ratios, but also sort of higher regulations around liquidity. So that's one concern that we'd have. The other one is really to the extent that this crisis manifests or transforms into a full-blown credit crisis. I think you've had a lot written about a credit crunch. So all these banks are now concerned about the outlook for deposits and are sort of pulling back on lending. And I think that story is only just starting to play out. Last week we had the Senior Loan Officers Survey come out from the Federal Reserve, which reflected tighter lending conditions, mainly around commercial real estate, but you're starting to see that in some areas in unsecured lending as well, like auto lending, credit card lending. So we don't know the answer to that yet, but there's a real and potentially growing risk that this does transform into a full-blown credit crisis, which is obviously a big concern if you're a bank investor.
Yes. So given that relatively scary backdrop there, can you explain to us what your current positioning is in the financial sector in totality, and just your sort of investments specifically around banks?
Yeah, the short answer is we are very, understandably from what I've just described, we are very cautiously and conservatively positioned. We, in fact, don't have any banking exposure at the moment in the portfolios. Most of our financial exposures in so-called non-banks. So we have some Chubb in insurance, we have some diversified financials. And on the banks, I think, just in line with the way Alphinity invests, we invest around quality businesses in an earnings upgrade cycle, and we are still very, very cautious about the outlook for earnings for these banks. As I said, regulatory costs, but also potential credit cycle, and we'll see about where interest rates go. So, we still think that the odds are that we're going to get earnings downgrades. We do acknowledge, however, that banks are certainly looking very cheap. Whether you look at a price to book or price to earnings, they are looking cheap. But I think for us, that's not enough to invest in them. We as I say, we need conviction on earnings where we actually at the moment don't see it.
Great, thank you very much, Jeff. For more information, please visit our website on alphinity.com.au for a recent note that Jeff wrote on the SVB collapse and repercussions of that, as well as our recent monthlies for our latest positioning. Thank you.
Thanks, Alfreda.